Should you build or buy a short-term rental? In this episode, we're going to cover all things buying versus building a short-term rental. We're talking about ground-up construction, not fix and flip, but ground-up construction compared to buy and hold a creative finance real estate short-term rental. So in this video, we will talk about the difference between the two and where I recommend that you start. I hope you enjoy this episode. Let's jump in. All right, what's happening, people? Episode 7 here of the Creative Acquisitions Podcast. In today's video, I'm going to take you through two options for short-term rentals. Option number 1 is buying your short-term rental using creative finance or conventional financing, where the other option is doing ground-up construction for your short-term rental. Now, keep in mind, primary focus of my real estate portfolio has been buying short-term rentals, and I'm entering into the building short-term rental space right now. And the reason that I'm doing that is because I'm trying to figure out whether or not there's a way to have manufactured equity within a property. Some of the people that I've worked with over the last year have been big believers in manufactured equity through properties that are fix and flips, where you can buy an asset for X and sell it for a price significantly higher than the money you put in. You buy it for $200, you put in $100, you sell it for $500, even though you only had $200 plus $100, which is $300,000 into a deal. It's worth $500,000. That's your manufactured equity. So the concept of the fix and flip, moving that over to development for short-term rentals, there might be an opportunity to create manufactured equity. So let's talk about the ground-up construction second. First, let's just talk about normal acquisitions. We've talked about this before. There's 4 main creative finance acquisitions. There's really more, but we could add lease options in there. But there's seller finance, subject to carrybacks, a bunch of different types of carrybacks. And then you also have your conventional financing, and you have hybrids, wraps, and lease options. So there's a bunch of different strategies for acquiring properties. Now, the strategy that makes the most sense for you is based on your situation. For example, lease options, extremely low money down, but you don't own the assets. You don't necessarily get the appreciation. Sometimes you do. You don't get tax benefits. You don't get mortgage pay down because you just have a lease option. If you don't exercise your option, you basically lose everything. But it's very low money down. You get into subject to. Hey, subject to can be great because you get in with low entry, you build equity over time. Those mortgages are typically good interest rates because they're from homestead buyers, but there's a lot of deferred maintenance on subject to properties. Other types of carrybacks, including seller financing and bank financing together, like in the commercial world, those great, but they have almost 100% leverage almost every single time, which means that it takes a long time for you to build equity. And the cost of loans typically are very high, both the interest rate and the origination cost. So those are some of the things to consider on the purchasing side. When you purchase this property, you can also do, FHA financing, VA financing, conventional financing, non-QM, bank statement, a million ways to finance on the back end. But the difference is when you buy an existing asset, there's already been a step up in value that has occurred from the previous owner. So if you look on Zillow at any point, you can just go to Zillow, put in your zip code, and find a house that's currently for sale. That house that's currently for sale will have a price, a list of pricing, what it's been on market for. Below that, you will see the last price it sold for. And I guarantee you that the price that it last sold for is less than the price they're selling for today. There are some one-off examples where that's not the case, but there is some value in there. And so the question becomes, right, well, if they got the value out, how are you going to get the value out? And that's a great answer. That's the problem with buying short-term rentals, especially creative finance short-term rentals. They usually have deferred maintenance, capital expenditures that are very high. And yes, you can enter a deal for a low amount of money, but they're harder to cash flow because you have to do repairs and maintenance, CapEx, more than you typically would think, and you're going to have some potential downtime. When you jump over to the building side, you can manufacture equity. Right now in Hocking Hills, we're working on a project where we're going to build a property for about $1.35 million, with its value being 1.8 when complete, which means we can refinance that property, get all of our cash back out, and own it with a bank loan. The problem there is that you have to get the bank loan, you got to be on time, you got to pay the interest expense as it comes up, you got to actually build the structure, and then you got to have an exit strategy. Are you refinancing? Are you selling it? Whatever. The process of going through construction is so difficult sometimes. There's permits, and there's the city, and then there's the inspection for, framing and electrical and HVAC and the roof and for septic and all these different things that you have to do on the building side. And so if you go down that path, you have to recognize, yes, you're going to have manufactured equity. Yes, you're going to be able to control the type of house you have. Yes, you can put the bedroom and bathroom where you want. Yes, you can have the furniture set up the way you want on day one. Whereas on these properties that are existing properties you're buying on market, you lose that control. You can't necessarily control how many beds and bath the house has. You can add them and delete them, but you can't control what it currently has. The furniture, the wear and tear, the roof, all the other pieces associated with it, you are not going to be able to control when you buy an asset. When you build an asset, you're going to be able to have much better control. And the reason you're going to have better control is because you're going to be able to build the blueprints, the drawings, the way you want them to be built, and then you can actually build that house in that method, right? So you can say, okay, the house is going to be 5,000 square feet. We're going to make it 10 bedroom. We're going to make it 7 bathroom. We're going to split the upper and lower like this. The backyard is going to look like this, and we're going to do this to the garage. Like, you can have this great control, phenomenal control to set the house up right the first time. And when you build a property, your capital expense and maintenance is going to be almost $0 outside of like grass and stuff like that, because you've built it. It's brand new roof. It has a 25-year roof. You don't have to touch it for 25 years. You buy a house that's got a 20-year roof on it, meaning you've used 20 of the 25 years. You only have 5 years left, which means there's a good chance in the next 1 to 5 years you're going to have to replace it and spend $20,000 on capital expenses. And so in your pro forma, when you build a pro forma, income, expenses, capital expense, maintenance, all stuff, you have to consider building new, CapEx is 0 or almost 0, right? 10 years old, CapEx might be 5% of revenue. More than 10 years old in some of these items, 20-year-olds, right? 10% revenue. So if you have a $100,000 a year house, $10,000 a year in CapEx might make your property cash flow negative, even though you're not spending that money on CapEx necessarily every year. You're just putting it in reserves. So again, let's just split this into two things. Buying a property, building a property. When you buy the property, you can typically get in with better financing, seller financing subject to wraparound mortgages, things like that. When you're building, you got to use ground up construction financing almost every single time, which can be very expensive and has a short window. When you actually get the asset that's old, you might have to do capital expense and maintenance very quickly in the first 5 years. When you build it, you're not going to have that for at least 10 years on almost everything, okay? So you got to ask yourself what's more important. Also, keep in mind the time value of money. If I build a house and it takes me 6 months, I lose the time value of money. My down payment for the construction is stuck there without anything to do. If I buy a house, I can get that house live within 30 days and boom, start printing money right away. So you have to ask yourself, what do you want to do? And in previous videos, we've talked about this. The graduation in the real estate space goes from wholesaling. You first wholesale, then you fix and flip, then you buy and hold, then you develop. There's a reason development's at the top. It has the highest risk, the highest reward. The most things can go wrong. It has a lot of holding costs, a lot of variables. It makes it that kind of expert level experience that you have to have. Whereas on the buy and hold side, you don't have to be as experienced. What I'd recommend most people do is that in the first probably 5 years of their 30-year journey, just buy properties. Don't try to develop anything that's too complicated. Just buy properties, and then later you can work on learning from those short-term rental properties and then work on development. The best things to buy probably are going to be seller financing and subject to for your first 2, 3, 4 deals. That way, if you do screw up, you don't necessarily have a personal guarantee tied to it, so you can walk away from a property easier than if you have a bank loan that's going to get you smoked. So very, very, very important that you think about a good strategy to make this work, okay? Now, the last piece of this whole strategy is just because you're at a specific part in your real estate journey doesn't mean that all the people you work with are also there. So if you're going to get into a development, make sure you're working with somebody who also has multiple properties. If you're going to buy short-term rentals on creative finance terms, make sure you're working with somebody who has similar experience level. If one person has way more experience than the other, you're going to have asymmetries in the operating agreement, which is totally fine. There's nothing wrong with having asymmetries in an operating agreement as long as you understand the person with more experience is typically more valuable. It is very fun to work with somebody that's equal or just a little bit more experienced than you, so you guys can learn together and progress together. Do development with one partner who does development. Do your buy and hold with a partner that does buy and hold. Doing them both together are going to be kind of messy. So find those people who have a little bit more experience than you, but not a ton, so you guys can have a balanced relationship. And within your operating agreement, you can maybe gift more equity or more appreciation or more cash flow or more something to that individual because they have more experience. But your options really are build something or buy something. And I'd always start with buying something. I really wouldn't play around with fix and flips personally. That is a place that you can make tons of money. That's active income, right? That's short-term cap gains up to 37%. So that's not something I'm trying to do more of. Whereas these other strategies that people have, this long-term buy and hold, refinance, that might make sense. But flips have a lot of unknowns. If you're going to go through the hassle of managing a construction project on a flip, you might as well just jump over to a development because it's the same skills of managing people, yet you get to build from ground up and you don't have to worry about all the crazy variables. So the next time you're considering, should I build a short-term rental or buy a short-term rental? I think the answer is buy a short-term rental for the first 5 years or 5 properties, and then you can work your way into development. I know this episode's been a little bit shorter here, but I'm trying to give you guys bite-sized nuggets on what I would do. And again, I'm not trying to provide you legal or tax advice or financial advice, just to explain to you what my journey has been and what I think makes the most sense for most people. In coming months, I might be getting back into some of the real estate trade business, and we can talk about that in future episodes. But as of now, I'm just putting out content to explain to you my whole journey and the kind of work that I'm actively doing today. So hopefully that's been helpful. And as always, thank you so much for watching.